A very good evening. Welcome you all to this public lecture entitled The Law of Finance and the Abyss. And we've got 4 speakers lined up. And the speakers are Katharina Pistor. She's at the moment at the law department as the Schmitzu visiting professor and normally teaches at Columbia. And next to her is Julia Black. She's also from the law department. And at present, she's our boss. She's the pro-director for research. Next to her is a true giant in economics, Charles Goodhart. And he worked for the Bank of England and is now an emeritus professor at LSE. And next to him is John Danielsson, who is also an economist and the director, one of the 2 directors of the Systemic Risk Center. And without further ado, I'll hand over to Katharina to present her thesis.
Thank you very much, Eva. And before I start my lecture, I just want to thank the London School of Economics, and particularly the law department, for hosting my stay here in London for the last 2 weeks, which was tremendously enjoyable. Also, thanks to the Center for Systemic Risk and the Financial Market Group for hosting this fantastic seminar that we just had this afternoon for speakers who came and presented their work here. So I'm enormously delighted to be able to present some of my thoughts here today. And let me just try to give you an idea of what the core features or the core thesis of my talk will be before I go into the detail. So I will try to make and substantiate essentially 4 claims tonight. The first is very, very simple and I think straightforward and certainly not difficult to understand for lawyers, which is that finance is coded in law and that, therefore, law itself can bring the financial system to the abyss. Second, if and when a legally constructed financial system has reached the point of self-destruction, this can be stopped only by the suspension of the full force of the law. Third, the selective suspension of the law has distributional effects, which can trigger political backlash, and those in turn will make it more difficult next time around when we have a crisis to manage it. Fourth, the way finance is coded in law has not changed much since the global crisis. We privilege finance actually not only at the abyss, but exemptions from rules everyone else must abide by are woven into the very fabric of our financial system, and I think it's time to begin to reconsider this as well. So let me start with 2 illustrations to recall what it must have felt like to be at the abyss of the system. Both illustrations are from the year 2007, but as Didier Sornat has suggested, a major crisis is actually a series of earthquakes that do not stop, and the series of earthquakes did start in 2007. So suppose you have deposited significant amounts of your savings in a bank that has done enormously well over the last couple of years, expanded its loan portfolio by about 20% year after year after year. But one morning you wake up and you listen to the BBC and you learn that this very bank has requested emergency lending from the Bank of England. You check your paperwork and you realize that about 2,000 of your savings of the total of 50,000 that you have deposited are insured. So you run out to the bank because you want to try to save the remainder of your money and you see long queues lining up. You run back home, you're trying to transfer your money online, and of course the system crashes. Okay. Illustration 2 is suppose now you work at a financial company here in London. And one day in the middle of the summer, when everybody else is on vacation, you get an email from a professional acquaintance who works at a client investment bank. The email, that's an original text. The email has the subject line, "Sorry to bother you." And the text reads, "Vacation, stop. Margin call coming your way, stop. Want to give you a heads up." The next day, your firm receives a bill over $1.8 billion from that very client, and suppose further that this was the first loss in 15 years on any of your derivatives portfolio. Now, the bank in my example, of course, was Northern Rock, and the other firm was IRG Financial Products. As you will undoubtedly have realized, the conversation did take place in real time between IRG GFB here in London and Goldman Sachs in New York in July of 2000. 2006. The amount of $1.8 billion, of course, looks like peanuts in light of what was yet to come, but I think both illustrations help me make one of the core theses that I want to present tonight, which is that modern finance is coded in law and that the enforcement of all legal commitments can bring the financial system to the abyss. AIG Financial Product and Goldman Sachs haggled over the amount of margin calls that AIG FP would have to pay out, but they did not haggle over the legal commitment that they had made ex ante, that if a particular, or their contracts had crossed a particular threshold as agreed in the contract, they would indeed have to pay out. And of course, paying out all the amounts that were due on these margin calls could, in theory at least, bring AIG Financial Products to its knees. Luckily, AIG FP itself had had an open credit line with its parent company, which gave it a little longer lifeline. But as we know, of course, today as well, even a multi-trillion-dollar company like AIG, parent in the United States, can be quite literally bleed to death, and therefore it had to be bailed out eventually. So both stories essentially capture what I mean by the law and finance paradox that I have formulated in a recent paper, which basically says that legal commitments make financial markets. This is true not only for old-fashioned banking, but it's actually even more true for the parallel or shadow banking system that we have today. A market-based financial system at global scale would not exist without law that makes commitments credible and differentiates rights so that some get better rights than others. Critically, however, the same legal devices that help build and scale finance to size can bring it to the abyss, and in the worst-case scenario, trigger its self-destruction. How then does law scale up a system to global size and complexity? Does this necessarily lead to downturns? And if so, how exactly does law bring down the very system it has helped create? So I'm starting again from the basic premise that modern finance is coded in law. I will try to substantiate this a little bit more by basically saying we have familiar legal institutions that are such, of course, are harmless, even positive, and are therefore largely deemed beneficial, which are the basic legal code, or the basic elements of the code of finance. And these are property law, collateral law, trust and entity law, and bankruptcy law, which validates all of the above. So the acid test for all of this is always in bankruptcy, and Charles Goodhart has made this point this afternoon in our seminar as well. These legal institutions have facilitated the expansion of financial markets to national and indeed to global scale. There is no doubt, of course, that personal trust, kinship, reputational bonds, and the like support many credit relations, even quite sizable ones. Yet these mechanisms cannot be scaled to the same extent that law can, because, quite simply put, law can be enforced among strangers, and law has become portable with the help of conflict of law rules, legal harmonization, and mutual recognition. This has made it possible to create a global system rooted in domestic law, and for the most part in the law of only two jurisdictions, the United Kingdom and the state of New York, with some Jersey and Cayman Islands sprinkled in. The quality of a legal right, that's really ultimately critical, especially in the bankruptcy case. The quality of a legal right is determined in relation to competing rights. Law can be employed to create stronger rights by way of prioritizing or asset shielding. So property rights are stronger than contractual rights. Secured interests are stronger than unsecured. And priority rules in bankruptcy determine the pecking order for those who have to settle with the leftovers. Trust and entity law create firewalls to protect assets from creditors of the original owner and those of the trustee or manager. These devices can also be used to repackage assets based on the nature of the risk and sell them to different investors, thus diversifying the risk, at least in theories. And of course, all of these elements can be seen in the examples I gave you above. So maybe this is less clear if we only look at our depositor at Northern Rock. She may have thought that the money in the bank was hers, and she now has to discover, of course, that she has nothing more than an unsecured contractual claim against the bank for her money, and that only part of that is insured. But looking at Northern Rock's funding structure, we of course see all these elements employed. Northern Rock did not fund itself in the traditional way of just having deposits to use the money then and invest it further, but it used sort of the pass-through model. And behind the pass-through model, we of course see the creation of a master trust in Jersey, where you securitize these assets and then you issue interests to your investors who buy them. And depending on what legal structure you use, you can also collateralize them so that they have priority next time around. So this is how you do securitization, or you do covered bonds. You basically use the legal mechanisms of trust, limited liability partnerships, limited liability companies, and collateral law. Similarly, in the case of AIG, the AIG subsidiary here in London, of course, was shielded to some extent from the parent company. It had a different corporate veil. It was a different legal entity, and yet they were joined at the hips again through an open credit line, a contractual commitment by the parent to offer financial liquidity, which helped bleed to death almost the parent company in the United States. The main line of business of the subsidiary here in London was to issue credit derivatives, and again, they use very similar mechanisms. You basically create a pool of assets, you tranche it, you hide them behind or put them into a legal shell, and then you issue interest into that shell. And of course, you make commitments to your investors that, depending on what the valuation of these assets are on the market, you will have to add up and pay up margin calls. So in a sense, property, collateral, and entity law ensure that some claims are better rights than others. That's what law does. Law is not only creating a level playing field, law has to create hierarchies to resolve conflicts. They're essentially the jokers in a game of cards. They trump other rights. Importantly, these rights are enforceable not only against the contractual party, but against anybody, any competing claim that is advanced by strangers, whether they did know about other transactions or had ever met any of the rights holders. That's what law can, that's what few other social systems or norm systems can do. Furthermore, property rights have been sufficiently standardized so that their content does not require proof. Once the right legal mechanism has been grafted onto a particular asset or interest, everything else follows because it's essentially hardwired in the law. Having a joker, therefore, enhances one's chances of winning the game. The more jokers one has, the more secure one feels, and the more bets one is therefore willing to make. But what if everyone has a joker? And how can that possibly happen? In a normal card game, of course, there are only two jokers, right? In the Roman law tradition, only those assets that were specifically enumerated in law could possibly be property rights. And even though the English legal system is a bit more complex and arguably also more flexible in crafting priority rights, nonetheless, at least traditionally, there have been certain procedures for perfecting rights that made it costly to achieve these priorities. In finance, in the area of finance, these legal restrictions have been eroded, often discarded as mere formalities that would make it more difficult to build financial markets. This applies to the perfection of security interest, the transfer of full title over a long chain of title holders, and to bankruptcy safe harbors for derivatives and repos, which effectively elevate these claims to super priority rights. Last but not least, parties can choose the law that shall govern these assets while also claiming that they are protected as property. Usually, we reserve the private autonomy to choose your law to contractual claims, but we have extended effectively this also to property claims. Put differently, the players of the game have been allowed to print their own jokers. The collateral guidelines of the European Central Bank and increasingly other central banks have added fuel to the fire. They have accepted an ever-expanding class of assets minted by the private sector as collateral for cash. If you have a put option to cash in your joker, of course, a joker inflation cannot necessarily devalue them. And yet there is a catch. How good a superior right is depends on how good the underlying economic interest is and how many others have superior rights. When the housing market tanks, even secured interests will be worth less than they were expected to be. Thus, the margin calls on credit derivatives at AIGFP. And even if, as in the case of Northern Rock, the underlying assets are not subprime and are still performing, the investor's appetite to buy more of the same in future securitizations diminishes. And if that's your funding model, then of course you will go down as well. Worse, everyone holds a joker, and actually they know that everyone holds a joker because they're all operating with the same master agreement by ISDA, for example. And so the key question is, we no longer actually know by what meta rules we will decide whose joker will trump. In that kind of context, I can't rely anymore on the superiority of my right, but time becomes of the essence. First comes, first serve. So I run, and of course we know what the effect is of a run. By exercising their so-called superior rights, the rights holders will therefore bring the financial system to its knees. We have known this, of course, since the first run on assets that gave us bankruptcy law, and since the first runs of banks that gave us deposit insurance, but strangely enough, not always workable resolution regimes. However, we have fooled ourselves into believing that risk could be purged from the system by decentralizing risk management to the parties with the greatest interest in making money of it. Once a run ensues, there are not many options left. Policymakers can choose between the Scylla of a debt moratorium and the Charybdis of offering liquidity where no liquidity is owed. A debt moratorium is almost certainly counterproductive in a world where financial intermediaries are part of a single highly interdependent network and rely extensively on refinancing. So rather than imposing a stay, policymakers in the last crisis, foremost among them central banks, have offered liquidity by selectively buying up assets that no longer had any takers. The jokers had become toxic. This, of course, is also a suspension of the rules, if not of specific contractual rights, of the basic rules of the game, because it undermines the very principle of a competitive market economy that losers are out, whether they are assets or entities. Moreover, unlike debt moratoria, which tend to be temporary, no end date was set, and it was all left in the discretion of central banks. It is probably fair to say that the central banks, the C5, the C6, however you want to put it, rescued our financial system in this past crisis, but they did this by effectively suspending the principal norm of a competitive market economy. They may deserve praise for the rescue, but almost 8 years since the beginning of the earthquakes described earlier, we have still not weaned off finance from liquidity boosts and quantitative easing. Perhaps even more damaging in the long term, the distributional effects of the rescue have undermined central bank impartiality, a key pillar of their legitimacy as independent agencies. Focusing the rescue operations on the core of the system, where its survival was at stake, may well have been the most effective way to stop the hemorrhaging. And still, those who did not receive support or received support only belatedly, amongst them homeowners, feel aggrieved, and you can hardly blame them for that. In response, lawmakers have begun to rein in central banks, and when looking at the recent congressional grilling of the Fed's chair, Janet Yellen, or the fraud inquiry into the handling of the liquidity auctions by the Bank of England during the crisis, it seems that we have not seen the end of it yet. Indeed, legal changes already implemented in several countries limit the discretion of central banks to provide emergency lending and require participation by elected politicians, mostly by ministers of finance, treasury secretaries, and so forth. Perhaps we will never face a crisis situation of the past again. However, notwithstanding the fact that many reforms have been implemented and some preventive measures have been taken, I'm not sure that we have really fully crisis-proofed our financial system. Indeed, I doubt that we could possibly do so. Most importantly, the basic legal code of our financial system has not changed. We have fiddled with the regulatory scaffolding, capital requirements, liquidity buffers, better coordination amongst regulators, but less so with the decentralized joker production. To be sure, some measures have been taken, such as the new ISDA protocol and exercising netting rights under the master agreement, but we don't really know yet how this will work and whether it will be effective, and we also don't really understand how it might affect the over-the-counter derivatives markets. Further, new financial instruments are being minted as we speak, using the very same building blocks that we discussed earlier, true sale and trust to make assets bankruptcy remote, property rights and collateral to give them priority in bankruptcy, and so forth. Just like their predecessors, these instruments are created in light of, indeed in response to, the regulations that have been put in place. This, after all, is the art of coding finance in law. By creating enforceable claims, preferably jokers, in the gaps of the regulatory scaffolding that will be inevitably left behind. Such a system is inherently unstable. The temptation to engineer rights that are better than those of others is simply too great. Such a system must necessarily rely on the implicit backstopping of the polity where the crisis happens to manifest itself, but we also, of course, have learned that not all polities are equally equipped to do so, and some actually also have signaled that they're no longer willing to continue in this role. Further, the system relies on the selective exemption from general legal rules meant to apply across the board, and importantly, not only in times of emergencies. Careful examination of legal change over the last decades or so in regards to financial collateral, the law of trust, conflict of law rules, and etc., suggest that we have built elasticity into the system, not only in moments of crisis, but into the various structures of the system. All this has been beautifully captured in a remark by the British legal historian Bernard Rudden already in 1994, who said in an article then, and I quote, "The traditional concepts of the common law of property were created for and by the ruling classes at a time when the bulk of their capital was land. Nowadays, the great wealth lies in stocks, shares, bonds, and the like, and is not just movable but mobile, crossing oceans at the touch of a keypad in the search of a fiscal utopia. In terms of legal theory and technique, however, there has been a profound, if little discussed, evolution by which the concepts originally devised for real property have been detached from their original object, only to survive and flourish as a means of handling abstract value. The feudal calculus," he concludes, "lives and breathes, but its habitat is wealth, not land." In the old days, the law of equity was the key building block for capital. In our own times, democratically elected legislators and, of course, the EU lawmaking apparatus have introduced legal change that exempt finance from the need to perfect financial collateral, to follow basic rules for title transfer property without losing the privilege further down the line, the application of certain bankruptcy rules, most importantly, stay and avoidance, and more in some jurisdictions than in others, the liability of trusts for managing trust assets. And this has by some authors have actually referred to this as trust stripping. There's therefore room, and I would argue need, for normative debate about the financial system and its legal structure that we want, and the appropriateness of accommodating law for the financial system, which of course has not only benefits but also substantial costs. We also need to think about the possible effects of systematically privileging the financial system on the rule of law and, of course, on inequality. Last but not least, we need more research about how legal privileges may increase the probability of approaching the abyss again. Thank you very much for your attention.
Thank you very much. And we're going to continue this evening in doing something that LSE is very well known for, and that is bringing together different disciplines. So we started out with a legal theory of finance that looks at law as sort of a toolbox that creates an environment in which finance can operate. And that very toolbox can then turn against the system when a crisis event occurs. And then something else needs to happen to remove the full force of these tools that have been craftily implemented. And I'm now handing over to Julia, who will illuminate this subject further.
Well, good evening, everybody. And again, thank you to Eva and for organising, Katharina for coming over, and Charles and John for participating, and obviously for you two for coming. So Katharina has given us a kind of challenging, part sort of familiar understanding of the role of law in markets and constituting markets, and a sort of challenge as to that which facilitates things can also destroy them. And I want to not necessarily take on that, but just a thesis, but just explore it a little bit more by thinking about the relationship between law, markets, and crises, and thinking about what it is that law does quite fundamentally within to create a market economy. So law, as Eva and Katharina have been talking about, has this, it's always talked about as having this facilitative role, right? Provides the infrastructure. It provides the infrastructure for exchange-based relationships, collaborative relationships, relationships in which are just spot interactions, and relationships which are stable and long-standing through defining particular organisational structures, partnerships, mutuals, companies, etc. And the way that it has done that has changed over time, and there's a significant literature and history on exactly the evolution of that relationship, and whether it is one which naturally moves to a functional efficiency at any particular moment, or whether it is one which actually isn't particularly efficient, but at least it's stable, so at least it provides that, to one which is fundamentally based on social power, and prevailing power relationships, which are then crystallised and in the common law system encrusted, in fact, because they stay for some considerable time in law over time. And so there's that idea that law is facilitating particular types of relationships, perhaps for efficiency, perhaps just for stability, perhaps just to favour the particular ruling class when that particular legal instrument was created. But it doesn't only just enable people to do what they want. It then has this sort of constituent role. It then defines what those relationships are going to be. And as Katharina has talked about, it defines that in the economic world by defining, and in other worlds as well, actually, that we live in, by defining rights and liabilities, and most particularly hierarchies. In situations of contest, who's going to win? One of the other functions of law is a dispute resolution role, and we're very used in the common law system to conceiving that as being the zero-sum game. And so the hierarchy, the ability to pull the joker out of the pack, as Katharina has been portraying it, becomes absolutely critical when crises and other moments crystallise. And also, as we've heard, in the financial space, law constitutes the products which are being sold. Which are being exchanged. They are bundles of rights and liabilities which are transferring risk. And so what law also enables to do is to separate, in some circumstances, individuals from the consequences of their actions. And it does that quite nicely and neatly. We know that through limited liability, for example. So law then has an interesting role in markets, particularly in financial markets, which are held up as being, kind of paragons of efficiency, if you were to look at them in a kind of very bare bones, basic, level 101 neoclassical economic theory. But when you actually look at the way that law is being used by its participants to constitute relationships, then it's being used to transfer risks and to transfer and insulate people from the consequences of their actions. So that, in particular, it creates the ability for agency relationships. And in creating the ability for agency relationships, you create participants who are not the end dealers of transactions, but who are acting always on behalf of somebody else. So they can always pass the consequences of the price of the trade further down the line. They never have to bear those consequences. Law enables them to cascade those out through the market. Paradoxically, that can mean that the markets themselves are quite inefficient. One of the challenging things when thinking about the manipulation of the different benchmarks, forex trades, LIBOR, etc., is that once you start poking around in the actual infrastructure of this market, you start to think, well, is it not blindingly obvious to the participants there that manipulation is absolutely possible? Why don't market participants care? Why doesn't the buy side care particularly that it's actually not getting exactly the best price? Is it just that it's actually, because it's so small, it's only 1 or 2 or less, point of a basis point off what the efficient price would be, that actually is going to take the hit for some other functional efficiency? Or is it actually no, because it doesn't actually have to bear the cost, as it were, of the inefficient price, but it can pass that down the line? So I think one of the interesting things about looking at what we have in economic terms been taught to assume are absolutely the paragon of the spot trade, the efficient market, are actually fundamentally quite inefficient. Why? Because the players don't care whether the price is efficient or not, because legally they're engaged in relationships which enable them to pass the consequences of that trade further down the line. So law does enable people to play. Okay. As Katharina says, the toolbox approach, I think is kind of a Meccano set with bits of clay in between, right? Because some of it comes in pre-packaged forms, but in fact you can actually build that in particular ways and in particular creative ways. So you have this juxtaposition of the malleable and the rather more sort of hard edged, pre-packaged components. So law does all of that. It constitutes the products, it constitutes the relationships, and it also, however, it gets even more complicated than that because law itself is internally heterogeneous. So we've heard about contract law, trust law, property law. In fact, each one of those different areas of law has its own logic, its own internal sense of the appropriate definition of a right, the appropriate grounds for a claim. And what you can do, if you're a really clever lawyer, is you can manipulate those to your heart's content. So you can provide the same functional efficiency from an economic point of view in terms of the distribution of rights and liabilities, but you can use different parts of the toolbox or different parts of the Meccano and Clay set to actually create that. What does that mean? That means that actually, although from a functional point of view, yes, a hierarchy has been there, yes, a risk has been transferred, etc. From an internal logic point of view, law is internally fractured. And that has implications for when we come to crisis, which is something I'm going to talk about in just a minute. Now, not only is law internally fractured on the common law side, of course, law is not just law from the common law side, you also have the regulatory aspect as well. And you have statute law, which has come in, and where law is used absolutely not in a facilitative role particularly, but totally in a political and instrumental role. That's what regulative law is. It is the embodiment of a political set of choices, compromise, and therefore power relations. And it may run at complete odds to the logic of the common law or the private law, because we're talking about common law systems. And you can see this in the area of fiduciary duties. Okay, so those of you who don't know about fiduciary duties, they're rather lovely. They're quite quaint now, actually. But they basically say that you have to look after your client's interests and you're not to take a secret profit from a transaction, and that you're not to have conflicts of interest and profit from those conflicts of interest without the kind of express consent of your principal. Lovely, lovely notions. Completely squashed now by contract law. Total extermination. Okay, contract law now enables you, after a slow attrition starting in the mid-1990s, to actually exclude any fiduciary responsibilities from your contractual relationships whatsoever. If anything was a death to fairness in markets, it's been contract law. Okay, and the English courts have been totally, totally on board in enabling that to happen. On the other side, the regulators have quite stuck to this notion of fiduciary, no conflicts of interest, but only for certain types of clients. I'm talking about the UK and to an extent parts of the EU. Their private law is having a different relationship, a different struggle going on between the different duties. But we have twin track running between the regulatory side and the private law side in the duties which are expected of principals to their agents. And it is a complete clash. We have common law running off the rails on one direction, and we have the regulatory rules defining those different rights and liabilities in a completely contradictory direction. So what happens when the two meet? Well, we have a hierarchy there as well, okay? And statute can pull out the joker to change the common law. But we have another thing which we have to bear in mind, which is who's writing those rules, because there is then a hierarchy within the public law sphere as well that actually has to be primary legislation. It can't be anything else. It has to be Parliament, okay? It can't be a regulator who can do that. And so we have different hierarchies within the legal structures themselves, and we have different logics within that box that we've so-called just been calling law as being internally heterogeneous and fractured. Okay, so all of this actually doesn't matter in good times. Okay, we don't notice it. Classic socio-legal observation about the role of law is that as far as parties are concerned, when they're interacting, they have no idea. Okay, it's kind of a hum that just goes on in the background. You turn on your car, you drive it, you don't care what's happening under the bonnet, it just kind of works, right? So, and in fact, your relationships may evolve in a way which is actually not the way that they were initially conceived and encoded, encrusted in your contract or in your different legal instrument. They will evolve in a particular way. Probably you don't even know, in fact, what your legal rights and obligations are that you're entering into. That, of course, is one of the classic or seminal or notable or whatever things that we found out in relation to the crisis, that actually people had no idea what types of rights and liabilities they're entering into. They haven't got a clue, okay? It paid a yield. What else do you need to know? Nothing, right? You just need to know what the coupon is, what the profit's going to be, what your risk might be, roughly, broadly, but actually you really just need to know kind of the coupon rate, and that's it. You know, don't ask any questions. And so people will enter into and are acting. So, okay, law is encoding finance, but invisibly. And people are interacting in ways they are actually completely, largely ignorant of the types of different rights and liabilities they're getting into, therefore the risk that they're taking on, let alone that there might be a hierarchy and that they will be at the bottom of the pack. So what then happens in a crisis? Well, as everything's been moving around quite happily, then when the music stops, as we all know, there are never enough seats to go round. And so all these risks crystallise. So then what happens is actually a hell of a mess, okay? Because in terms of the scale, the complexity, but in terms also of trying to then, for law itself, what happens then is law ceases to operate in its facilitative role, but actually takes on its dispute resolution role, and in so doing has to reconstruct the relationships which have been created by people playing around with the sandbox, or in the sandbox with all the tools and clay and whatever metaphors you want to bring into mind. Because all of those things, one of the things about freedom of contract is all of these things are valid, all of these things which are created are valid until they are tested in the court. Then when a crisis hits, they come into court. Court and dispute resolution mode now actually turns into categorization mode, taxonomy mode. It looks at what is being created, looks at its own internal heterogeneity, and says, okay, well, which bit does this fit into? Does this fit into a trust bit, a property bit, a contract bit? In which case, which logic then applies? Is it the trust, is it the property, is it the contract? Or is it some kind of melding of those? Can we meld? How can we cross boundaries? Can we cross boundaries from these different logics from one to the other? From the tort to the contract to the property? Or do we close them down and say, no, you've actually just got to be definitely one and not the other? And as we're using, as Katharina talked about, we're using constructs which were created, centuries ago to apply to physical property and which encoded themselves, their own power structures at the time. That categorization moment which occurs on dispute resolution can be hugely disruptive across the markets. Why? Because nobody anticipated it. Because partly it might not have been able to be anticipated because the courts don't always follow what it is the market's doing. Okay, sometimes they'll sit back and say, okay, well, the market's doing this, the market thought that, okay. But, they have some pride. They are the owners of the law, and they will be saying, well, actually, no, you thought you were entering into X type of relationship, but in fact, the way that you've constructed these tools that you all assembled means that, in fact, your relationship is this. Parties weren't prepared for that. They didn't cover for that. They didn't hedge for that. Perhaps what they thought was a joker turns out to be not a joker after all. So I think when we talk about needing to suspend law in order to enable the crisis to be resolved, we need to think about, well, which bits? Is it a suspension of law, or is the shock that, in fact, the way in which courts are then interpreting the contracts, the things which have been created, are causing disruptions across the market because of the way that they were unexpected? And moreover, what role does regulatory law play in this? Because in some instances, we actually had to create law in order to handle the crisis. We were lucky in the UK. Northern Rock gave us a dry run. Okay? It enabled us to pass a piece of emergency legislation through Parliament to give the Bank of England a stack of powers which are now basically encoded in the European resolution regime, more or less. Okay, if we hadn't had Northern Rock when 2008 hit from sort of March, April, May, certainly June, July, we would have been in serious trouble. The lifeboat let's all get around the table and kind of bail it out would not have worked. So in fact, we needed law at the time of the crisis, certainly in the UK, to give public authorities the powers to actually sort out, as it were, the mess that had been created by the private actors in the market with the toys that they created. So I'm going to leave it there, but just by closing on a few sort of closing points. First, that the integration of law and markets is fundamental. Okay, law provides the infrastructure, you know that, it constitutes relationships, it constitutes products, and enables stability. It also enables markets to be inefficient because it enables people to pass on the consequences of their interactions further down the line, such that they are not in the least bit interested necessarily in price efficiency, as long as they can hide the lack of price efficiency from their principal and make sure that they are profiting themselves along the way. Further, the law is internally fractured and heterogeneous, and further that it itself has its own hierarchies because it comes from different sources. In normal times, none of this matters, okay? It works. People carry on. But in terms of crisis, that's really when law comes into its own, both in the positive and in the negative, but also the fact that we may need law on one type of law, which is the enabling statutory public law, to enable us to sort out some of the mess that those playing in the private law field have created for themselves. Thank you.
Thank you very much, Julia. I think we now know a bit more about the limitations and the sort of the kind of tool that law is. And it seems to be a tool that acts in an invisible space initially and allows actors to shield themselves from liability and responsibility. And then when its full force becomes apparent, it sort of pulls out tools that allow us to modify sort of the results that would otherwise occur. And so there's something about the law that makes it sort of flexible, slightly perhaps unpredictable, and I'm quite keen to sort of hear a reaction from the economists in the room about how they feel law and finance and law and economics interact.
Thank you very much. Pleasure to be here. I entirely agree with my two legal colleagues that law provides absolutely essential basis for the conduct of finance. I would start us with a sort of slight comment about what Julia said about not really knowing what is in the contracts that form the basis of all the undertakings that we in finance carry out. And this is, if you look at these documents, they're usually about 190 pages long, and my God, are they boring. And I try to read some of them through, and I get about as far as page 3, and then I give up or go to sleep, or both. And frankly, you lawyers have a sort of underlying sort of, I'm not quite certain what the right phrase is, but you know what is the boilerplate. And you know that there are about 4 or 5 places in these huge contracts which you actually have to look at. And we who are not lawyers don't. So you know what's in them because you only look at the odd bits that really matter. We don't know what matters and what doesn't. We get bored stiff, and so we never read them. So and it's a kind of legal conspiracy to ensure that you're the only people around who actually know what's going on. And I don't actually think that yes, you're quite right. We didn't have a proper resolution law, and insofar as a bank was going to be resolved, it was going to be resolved under the same bankruptcy law in this country as any other company, and it was entirely inappropriate for banks to be resolved in this way. And Northern Rock did give us a wake-up call. It actually didn't, in my view, make very much difference to to what happened in 2008, 2009. What did make the difference was the G20 determination that no significant bank would be allowed to go bust. So that the resolution law has not yet been actually ever put into... there was one Scottish tiny bit, but it was so small, I don't think anybody noticed it. There hasn't been a significant bank which has been resolved, and the whole of the resolution basis is still, and the resolution law is still, you might describe it as in motion. Now, the bit that I really found interesting and most surprising in what Katharina was talking about was the suggestion that when you get to a crisis, or perhaps a really serious crisis, the only way actually to get out of it is to suspend the law. And that did make me sit up, because when financial affairs are going reasonably well, as I think both Katharina and Julia said, you don't really notice the law, because what finance essentially is it's a people provide, the lender provides money, and the borrower promises to repay. And as long as that promise is carried out, end of story, really. So the law really only comes into its own when the promise is not carried out, or not carried out properly, or not carried out fully. So it's when things go wrong that the law really does come into its own. Because you've got to decide then, when things have gone wrong, who has what right to what. When things are going right, it's just sort of, as I think it was Julia said, it's sort of humming noise in the background. So is it really the case that when a full crisis hits that you've got to suspend the law? And this really did surprise me. I'm not quite certain what laws it was that are being suspended. Because the crisis was effectively resolved by the authorities and the central bank. The central bank's providing liquidity, which they're always able to do. They have an absolute right to do that, breaking no law. And the ministries of finance stating that if the worst came to the worst, that they would use funds to support the continuing operation of the banking system. And again, they can do that. And I don't actually see what laws are being suspended. I don't really follow this idea that when you've got a crisis, you've got to suspend the legal system. Certainly the legal system would be put under pressure. I think what would happen to the legal arrangements, if Greece should have a disorderly departure from the euro, and the legal problems would be huge. But I don't know that you would suspend them. And I really found that really quite difficult. And indeed, the central banks have got far more power after the crisis. They got macroprudential. The Bank of England has got the PRA. Central banks are now doing far more than they ever did. But in what way has that been a suspension of the legal system? Admittedly, there are loads of people who think that central banks have got too much power, and that there ought to be greater boundaries to what they do. But I really am. I'm surprised by lawyers saying that when things get tough, you've got to suspend the law. I thought that's actually when the law comes into its own. So I was a bit. I find that bit very difficult to understand. And I hope that Katharina will come and elucidate a bit more what she means by, when you get into a real crisis, you've got to suspend the law. 'Cause I just don't follow it.
Thank you very much. Very important question thrown back at the lawyers. But before I give the floor back to the lawyers, I'll invite John to give his view on the topic.
Now, I do want to thank Eva for creating this fantastic event, and especially for assigning me to read the papers of Julia and Katharina. I mean, I think both papers, they definitely do succeed in expanding our understanding of this very complex financial system we live in. I learned a lot, and my thinking and my writings on this subject will very much be affected by what I read. Economists, as both authors sort of point out, tend to ignore law just a little bit too much, especially when it comes to systemic risk. And of course, this is exactly why when we set the Systemic Risk Center up in the first place, we were very happy that both Julia and Eva were founding partners of the centers and work very closely with us, because you can't separate the law away from finance. However, in reading the papers, it was not all smooth sailing. I had the impression at times that both authors were deliberately set out to upset us economists, especially the neoclassical type of economist. And here I have to make an admission. My name is John, I'm a neoclassical economist. I think the problem really arises because of terminology and methodological approaches are so different. When one writes across disciplines, language becomes very important, especially since particular phrases and concepts can have very different meanings in different disciplines. In economics, what might seem to be common language to us, understood by all, with a particular theoretic understanding is as hammered into you going through graduate school, can seem quite alien and bizarre to a lawyer. And I think that really came across in reading both papers. However, that's detail and not important. Fundamentally, I think that the legal theory of finance as presented in Katharina's paper and the sociological dimension in Julia's papers and both of the talks today are very important contributions to the literature, and I think very complementary in how they expand our understanding of the world. One could, though, expand the discussion a little bit by, for example, a discussion of how politics interacts with the system. Katharina's Columbia colleague, Charles Calamirez, has a fascinating book on how political considerations and lobbying strongly affects evolution of financial systems and financial markets, how that makes some markets and some countries fragile and ineffective, and others not fragile and robust. And in reading both papers also, I did miss a discussion on what is the objective of the whole exercise. And I don't think that was mentioned in the discussion very much either. What is the point of the financial system? Does the financial system meet our objectives or does it not? And if not, how should one go about constructing a financial system that better meets our objectives? And perhaps this is the one area where the economists can make a contribution to the overall discussion. Now, the title of today is The Law of Finance and the Abyss. And I'm going to talk a little bit about the abyss. And perhaps starting with the mathematization of finance, as Julia talks about in her paper. Financial instruments are very often priced by complex financial models, and certainly they are risk assessed with models. All of these models are fragile, and all of these models have non-verifiable assumptions. These models are inaccurate and very easy to manipulate in a way that is non-verifiable. Not too dissimilar from Julia's example in her talk about clever lawyers. So I think the mathematicians just play that role in a different part of the system. The mathematization of finance directly undermines other forms of rules imposed on the system and undermines the objectives of the authorities. Market participants are, of course, directly incentivized to maximize the complexity of the operating environment they are in and to make finance as complex as possible, and mathematics is a great tool for that purpose. And the authorities are highly supportive of that. The regulators, the system is so complex that one now needs sophisticated models to understand the system, models that distill extreme complexity into a small set of numbers. The regulators like this because it gives them the pretension that they understand a complex system because they have numbers on a computer screen. I think this is just a recipe for manipulation and ineffective regulations. Perhaps the financial system is so complex that it does not lend itself well to regulation by micro rules, as so common in the Basel Accords. And if we try to regulate the system by macro rules, it is all sorts of unforeseen consequences. Now, one of the great dilemmas of financial regulation is that we want a financial system that is safe and avoids crisis, but we also want a financial system that contributes to economic growth. And of course, these objectives are not compatible. Now, one simple manifestation of this is that the authorities have been very successful recently in curtailing risk-taking. And anybody who warned against this a few years ago, especially about the distributional impact of increasing capital, they were ignored. The politics said reduce risk. And we had to keep it's all politically driven. Today, the authorities, at least in Europe, have woken up to this danger of what they now call de-risking and say is bad, even though it's all driven by regulations in the first place. And they noticed belatedly how it disproportionately hits SMEs. And that has, of course, given rise to another political solution called the Capital Markets Union. And so the cycle continues. An LSE professor writing in 1944, Friedrich Hayek, and he was writing about central planning at the time. He might just as easily have been writing about financial regulations and macroprudential policy. It is not possible for the authorities to understand the system sufficiently well to prevent the wrong type of behavior. It is not possible to aggregate all the relevant information in one place in order to exercise effective control. Instead, the tool used by the authorities, both in the private and public sectors, is to rely on models and to rely on laws. But models just present a caricature version of the world. A caricature version that not only misses its salient features, but even more importantly, allows financial institutions considerable scope for manipulation of the rules. Laws only capture the danger as seen by the writer when the law is written. To this, we can add a key insight from economics, which is that the financial system is not invariant under observation. The large number of students who are studying finance in LSE, be they in my department, finance, or Julia's department, law, they're not studying finance out of an abstract academic interest. Students interested in altruistic study do not pick finance in LSE. They're studying finance so they can influence the system for private gain. Any study of the financial system endogenously changes it. And that is why it is so hard to regulate finance. But however, that's not too pessimistic. This is also why the financial system is so resilient. If the financial system gets into a crisis state, the private incentives of economic agents is to behave in a way that pulls the system out of a crisis. The financial system is self-correcting. It pulls itself away from the abyss in time. And well-meaning macroprudential regulations are unlikely to make the system more stable, while certainly they make the system more costly and more protective of incumbents. The resulting costs are borne by the most vulnerable and important marginal borrowers in the system, the SMEs. Exactly what we need for economic growth. I saw a number in the Financial Times this week that said large banks, now 10% of staff of large banks are engaged in compliance. That just cannot be a good use of resources or have a good impact on SME borrowing rates. I think it's much better to borrow from Schumpeter and his notion of creative destruction, encourage competition and discourage protectionism and discourage state guarantees. The financial system is founded by law, and that is why Katharina's legal theory of finance is so important and it was so interesting for me to read. That has definitely many lessons for us economists. And similarly, we economists do tend to ignore the connection of finance to society, and that is also why Julia's paper is so fascinating to read. And with that, I do thank them for coming here and speaking to us on this topic.
Thank you very much to John. I'm delighted that not only lawyers manipulate, also those who build models and mathematicians do. It makes me feel better. Before I hand over to the floor for some questions, let me allow Katharina in particular to respond to Charles's question about was it really the case this law was suspended?
Thank you. Is this on? Yeah.
I think it's
So let me just make clear that I don't think it's a good idea to suspend the full force of the law. Ideally, we should not. I would also admit that sometimes line drawing becomes difficult, right? What is an interpretation of a legal rule and what is actually a suspension of that legal rule? There's a gray line here, right? And we can, of course, have a debate case by case. But let me just start with the basic principles. If we enforce a debt moratorium, that's clearly a suspension of the full force of the law. We're using law to suspend the contracts. We are using law to suspend the commitments. Now, functionally speaking, I don't think there's a difference between saying I'm going to suspend your contracts or I hand you the debtor the cash to pay your creditors, although I don't owe you the cash. So the key question is then, do I owe you the cash? And that depends. Well, banks that had access to the discount window of the central bank, they had a right to access the discount window. Others did not. There was no good reason for the investment banks to get access to the discount window. They were basically told to transform themselves overnight into a holding bank and thereby get access to the discount window. AIG was an insurance company, and you could lend to it only under a Federal Reserve Act provision that says you can lend against adequate collateral in times of emergency. So the Federal Reserve is basically exercising its emergency powers. Now then the big debate is what is adequate collateral. And I talked to a lawyer who was deeply involved in the rescue of AIG and what they actually did. They had decided for Lehman Brothers, they decided it's not enough adequate collateral. The bank is basically insolvent, so we have to let it go. And then we see what happened. So we basically played by the rules, we see what happened, the bank went under. With AIG, of course, they already had cold feet, and in order to justify, to invoke the provision under the Federal Reserve Act that allowed the Federal Reserve to lend, they basically had to find equity. So they walked over to the offices of AIG and tried to find all the certificates for shares, that they have real equity there. And they opened the doors that hadn't been opened for quite some time. So again, where's the legal documentation? Then they thought they found enough, and they said, well, we now have to go back to the New York Fed. Should we get basically an armored vehicle? Because we're talking about billions of dollars of equity now backing the commitment that the government is basically going to make vis-a-vis AIG. And they decided that that would be actually too much of, sort of a stirring up journalists and the media. So basically they put it in the back and they walked back to the Federal Reserve. So you could say, of course, in this case, this was backed by the Federal Reserve Act because in emergency situations you can exercise your lending powers. But it's a rather extensive interpretation of the Act, and I think has been discussed as such. It could still be within those powers, but functionally speaking, I don't think there's much of a difference between saying we are now enforcing a debt moratorium or we're giving liquidity, where under the ex ante rules there was no expectation and certainly no legal obligation to offer liquidity. So we have to. So if we basically let the system play out itself, then we have, of course, a run in a situation of a crisis. If everybody enforces the rights as they had committed ex ante, we will have a run. We have to play it out. We have to go through the full cycle of devaluating assets and panic fire sales of asset. If we want to stop that, we at some point have to tell some people to stop who think that they have rights that they want to enforce. Right? We use, of course, bankruptcy as a way to buffer the effects. Saying stay, everybody stays. It's a legal rule, and now we're trying to sort out what's going on. But we have allowed too many parties, I would argue, to have rules that allow them to pull out the assets before bankruptcy, even after bankruptcy was invoked. That's part of the netting rules, right? And in that situation, if you're there, you basically have to tell them ex post, actually, no, you can't, or you have to instead, because you don't want to do this, you don't want to be so explicit about suspending the full force of the law, you use the liquidity injection, but functionally speaking, I'd say it's the same thing.
Thank you.
Not convinced. Central banks are not supposed to lend to insolvent institutions, but you never know what solvency actually is at a point of time. And go back to your Northern Rock. And if you took the losses that had been incurred up to the time when Northern Rock got into trouble, the losses were fairly small. If you could look forward at the expectation of what might happen, given the probable downturn in the housing market, Northern Rock was insolvent. So looking at it one way, it was solvent. Looking at it another way, it was probably insolvent. The solvency of a corporation depends very much on what you think is going to happen. And nobody knows what's going to happen. So you can't, unfortunately, the word solvent and insolvent is so fuzzy as to almost be meaningless. And meanwhile, a central bank has an overriding objective, which is to maintain the health of the country as a whole. And if it needs to extend the line of collateral on which it's going to lend, that's in support of its overriding objective. And I would have thought, yes, of course you can interpret what the position of a central bank is, but certainly with Section 13.3 of the Federal Reserve Act, I don't think the Fed ever overstepped, nor did the ECB, nor did the Bank of England, nor is the Bank of Japan. You have to be a very tight interpreter of the law to say that the central banks suspended the law during the crisis.
Maybe we can find some middle ground by saying there's basically, in the middle of the crisis, we take recourse to the elasticity of the law.
Correct.
And then we give somebody, and of course, according to Schmidt, always the one who calls the emergency situation is the sovereign. So in the end, it's the central banks in our systems who determine when the law should be more or less elastic.
But that's in support of an overriding objective for the social welfare of the country.
But we could have a normative debate about whether we can achieve that by offering liquidity here or offering liquidity there. So I do agree that the central banks did a great job in basically rescuing the system, as I suggested, but I also would argue that what they've done had certain distributional effects and probably also could have been done differently.
But everything the central bank does is distributional.
I agree with that.
There is nothing it does. And it's actually virtually impossible to think of an actual action of a central bank which does not have distributional effects. It's just whether you like them or not.
I think it's also we've only just noticed as well. Actually.
Good Lord, what were you all doing? Central banks basically lower and raise interest rates. When they do that, they have an enormous distributional effect between borrowers and lenders as part of the exercise. Did you really not notice that, Julia?
Okay, thank you very much. Let me hand over to you. I think I'll collect a few questions and then invite the panel to answer. Ron.
So I would, as an economist, like to follow up on the puzzlement that Charles Goodhart expressed. And it is rather strange to think about a suspension of the law without thinking about on what basis. What's the legal basis for the suspension of the law? And shouldn't be internally consistent. So is there in the law that prevails in the United States and in the UK, either based on precedent or on legislation, clear guidelines for when the suspension should take place and who has the authority to invoke it and all the rest of it. So, if you are thinking about a solution to the puzzlement that you have given us, would you think of a solution should be internal to the law, so it would happen spontaneously through some sort of corrective mechanism in a decentralized way? Or is it a hierarchical solution? Or do we have to say the Queen can decide, or the Prime Minister, or somebody? Is it a hierarchical authoritative power decision? How would you respond to that?
Yeah, a couple of comments and some questions, just to balance that comment from The Economist. I guess the comment, and I guess it's the lawyer in me coming out, if I could weigh in on behalf of Katharina against Charles's puzzlement there, that if you were, for example, one of the Northern Rock small shareholders who fought very hard to use a law that they felt had very much been suspended, the European Convention on Human Rights, to protect their basic property ownership, then from that point of view, yeah, even though a definition of solvency had been on an emergency basis implemented into statute law and upheld by the courts to trump another layer of law that they had felt guaranteed them some protection, and why can't we trade forward and look forward and get out of this, then it comes back to Katharina's distributional points. There are many left behinds who subsist out with the official sector and the London-centric financial system who are still feeling those distributional effects. And just a comment on how you know how we lawyers feel. When you get to page 3 of those boilerplate OTC contracts, that's how we feel when we're reading law and finance literature and we get to the models and the maths. That just makes me feel so much better. Okay, I could go on by way.
Okay, yes, please.
This is also for Professor Pistor. I was just wondering if you could explain a little bit what you mean about property rights as trump cards. I think that was my understanding, at least, that property rights serve as trumps over other rights. If you could just explain that a little bit.
Okay, thanks. Why don't you go ahead?
Okay. So let me take them in order. The first on the puzzlement, is there a rule who gets to decide? Not quite that explicit, right? And I think it's probably going to be hard to write such a rule. So we do this, of course, in constitutional law. We say who has the power to declare war, but we still have basically an opt-out and say, you can have, preventive measures or preemptive measures can be taken by whoever is the executive, but then you have to go back to Parliament. We don't even have that second step necessarily for central bank emergency lending. We basically leave it to the central banks, and the elasticity of the legal rules that allow you to make these kind of decisions have changed over time. So one reading of the crisis in the 1930s would have been that the Federal Reserve at that time was reined in by legal rules that didn't allow it to accept certain financial assets and lent against them. And so they let the system around itself collapse because they would not break the rules by which they were reined in. So then 13.3 was put on the books, so they would have the kind of flexibility to do so. Now there's a debate about Dodd-Frank, how much it might have tried to rein in this particular thing. So in an emergency situation, so you can't really anticipate all the emergencies, so you can't really easily create the meta rules. You can hint at who will do that and ultimately have to trust these agents. There's a big debate in constitutional law whether we should have a legal framework for emergencies. The danger of that is that you normalize emergency. So some people say we should not have and just hope that somebody takes then the emergency measures and after that comes back into the legal framework, but we can't really provide for that. So this is really, I think, a hard call. It's a real dilemma. Now, I think if we have a legal framework that is sufficiently elastic, then the central bank will do the right thing. But we can have, I think, a debate about how far it should go vis-a-vis, the smaller shareholders or others. Or one thing that I have been taking issue with in public is sort of the notion that the C6, the major central banks of the world, decided in the fall of 2013, I think it was, to institutionalize for good the swap lines that they threw to each other in times of emergency. Right? So in times of emergency, they say, we will help each other out with our currency so nobody suffers from reserves running out. But do they actually also have the powers under their statutes to institutionalize that and to select that we have these institutionalized swap lines amongst the C6, right? Why is Switzerland in? Why is Brazil not in? Who makes that kind of decision? Why should they have that? I think these are important questions to ask. Now, I just want to be understood correctly. I'm not on the side among some people in the United States who think they want to abolish the Federal Reserve or rein it in completely. I think we need this buffer. That's the whole point. If we build a system that is rooted in rigid, enforceable legal commitments, which we need to scale it up, at some point we need to have a safety valve right? And somebody has to sit at the valve and open the chutes or close the chutes. There's just no way around that. The question is, how do we balance this particular action? And that's just not so easy. So I don't think there's a fixed set of rules. We are, of course, debating this with the ECB. What are its rules to do this kind of OMT, right? This is why I went to my home country's constitutional court. And this is why the ECJ is sitting over that case as well. Just on your point, I think in the paper, which I couldn't present here, of course, in full, I talk more about sort of the core and periphery, or the apex and the periphery of the financial system. So the point I make, and I think that calls for a deeper political economy analysis at some point, is that when we look what happens in emergency situations, we tend to observe that the law is made more elastic and sometimes even suspended at the apex of the system, less so on its periphery. So on the periphery, we enforce the contracts. And at the core, we don't, because there we think we have to save the system. Of course, that sort of reinforces the distributional effects that I was talking about. Why do property rights trump contracts? Because I can enforce my property rights against anybody, not only against you. So we can have a contract, right? And we can sort of negotiate sort of over a particular good, and then we have an obligation vis-a-vis each other. Somebody else comes along, and once I have something, if I have the asset right now, then I have control over it. So this is basically one of the most simple, principles in law. In the Roman tradition would say you have a right in rem, or you have a right in personam, you have a relative right, or you have an absolute right. Property is closer to an absolute right. Nothing is absolute in this world, but it's relatively absolute. Contractual rights are relative, and so you have a more powerful right as a property right. You will always see this in bankruptcy. So if you go bankrupt, but I have borrowed you my car before, I can get this car out, right? And the other creditors are barred from taking the car and putting it in the pool and trying to put their hands on it. If I didn't own this thing, I didn't have that right. If I just had a claim against you to give me your car for a right, I have a contractual claim. I have to wait until all the other assets are settled.
Okay, thank you. Yes, please.
This down, please.
Thank you. I'm always intrigued by the difference, the variance between the penalties that banks are forced to pay, arm twisted by the Attorney General of New York, for infractions, and what the relatively comparable infractions incur in London. And I was just wondering if Professor Pistor could comment on whether she feels that sometimes the U.S. authorities, both the SEC and New York City and the Department of Justice, if they play fair, the amounts that have been paid out by the banks, I mean, I think it exceeds $100 billion in addition to the legal fees. Do you have any sympathy for the banks located in New York City?
Any other questions or comments?
So I'm surprised that this was all framed as law being central and, if you like, a necessary precursor. Most markets, in fact, operate in a world of trust. And the problems, reliance upon the law is only in the event of dispute. And there, of course, we're used to such things as absolute priority going by the board. The other question I would ask is, which is related to Charles' question, is the Fed exercise of Article 13.3 an exercise in public law? I thought the Fed was a private institution.
That's a good question.
Okay.
So I just wanted to chip in into the discussion of whether we can talk of law being suspended in the middle of the crisis. And to some extent, I think it's a matter of language and actually calling attention to what is happening, because of course we are living in mostly, I think, in countries governed by rule of law, and we would never like to admit that the way in which law is actually enforced is not clearly defined and determined ex ante. So ex ante we operate under the belief that, well, actually rights are clearly defined and that we know what's going to happen. And no, it's not really the case. There are some flexibility clauses in the law which can suddenly, and the key issue I think is that we don't know when and how and why and for whom, be defined, determined, interpreted in a more elastic way. And I think there's a great example in the paper given actually concerning the way in which German courts dealt with hyperinflation following the war, and suddenly they found a very elastic way to interpret contracts which were quite clear, but they found that, well, the law allowed them to interpret those contracts in a way that would allow them to escape a crisis. Was the law suspended, or was it just interpreted quite differently? It's a matter of language, maybe.
Thank you.
Yeah, so on the first question, do I have any sympathy for banks in New York? I'm not sure I have any sympathy for abstract institutions like that. So if you can show me that they unjustifiably got sort of slashed with some amounts of penalties or fines, then I would say, well, you'd have to deal with this on a legal basis. I'm not sure sympathy is the right thing, but obviously they should not maybe unjustifiably be slashed with these kind of obligations. But beyond that, this is the rules of the game. Trust and markets, yes. As I tried to say in my talk, obviously many markets are based on trusts and relations, but you can scale these trust relations only to a point, which is why the City of London worked so well until there were only, until sort of you got migration of other institutions to the city and you did different things. Until we wanted to scale financial markets beyond a few financial centers and go global, we could rely largely on trust, and we still do this to a certain extent, but you can scale your relationships much better with legal commitments, because you can create these kind of expectations that I have a right that will trump in the end, so I don't have to trust you quite as much, but I can rely on legal commitments. We had an interesting paper presented this afternoon by Alan Morrison, who actually had statistical data showing that the investment banks had a lot of relational lending and relational advising business going on in the 50s, 60s, 70s, and completely switched to a model much more based on law, which actually allowed them a lot to scale up their relations, to have many, many more clients, and to dole out much more money. Of course, it also made the system a little bit more vulnerable to abuses of power, etc. So there's a trade-off here, but I don't think we could have a complex derivatives system, for example, a complex financial system with these kind of instruments. Maybe we don't want them, but you can't really replicate them in trust. I think you need law for that. Is what the central banks do, is it public or private? I mean, I think in the United States there's always this debate: is this a public institution or a private one? Sometimes Congress said, well, send them a tax bill, then we will find out whether they are private or public. I think in that situation they would also like to be public. I would say whatever it is. I mean, in the England we had the much better case when the Bank of England was still private. It did fulfill public functions. I don't think it matters actually how you've been created, but how you perform the functions and whether then you can regard them as more public. So I think whatever its particular legal structure, the Federal Reserve clearly has a mandate to price stability and actually full employment in the United States, as all these are public functions. It's not a profit maximizing entity.
Okay, last call for questions. Yes, please.
You
said that as far as we want the financial system system to be both safe and that it should contribute to economic growth. Surely traditional prudent banking did both, and it's just casino capitalism, heavily unregulated, that has produced both lack of safety and has stalled growth.
Okay. There's one more question here. And one more, maybe the one in the...
I should balance. Professor Black had an interesting idea. I heard about how a law is written in the interest of the strong and the powerful. I wondered if she or other members of the panel wanted to take that idea. I hope I've got the right idea. And make any forward-looking statements. Can you discern any trends in the law that you want to draw to our attention? That, for instance, creditors are getting stronger and so law is moving in that direction, or are sovereigns getting weaker and therefore law is moving against them? Is it possible to take that idea and make any forward-looking statements out of which private agents and financial markets could make one?
Okay, I think last question over here.
Hello, I'm currently studying law here at LSE. I just had a question in relation to financial regulation. With fines being levied to banks increasingly from the foreign exchange market, rigging scandals and LIBOR and Euribor, what are your personal predictions in the coming years for financial regulation? And do you think that there will be any real changes to financial regulation or any real impact to banks in the future?
Okay, thank you very much.
Do you want to go first? Okay, so so how can you make more money? Is that right, Tim? Is that the question? No, in terms of power distribution, I think one of the clearest ones, which is encoded, not actually, is in relation to claims between creditors and shareholders and creditors. So you look at the way the companies will construct their financial arrangements is obviously geared normally around tax. Okay, debt is very useful from that perspective. Okay, because it's tax deductible structure, but your ownership structure is geared towards your shareholders, obviously. So your shareholding, and that is then embodied by and enhanced, in fact, by some of the regulatory moves which we're putting in place, which are to enhance shareholder control over managers and to give managers more shares. Okay? Now, the shareholder payoff is fantastic, right? Okay, you put in, you get all of the upside, you get none of the downside. Okay, the payoff for a debtor is completely different, even a debt instrument. So in terms of the way that law encodes, as it were, different types of, or privileging of different types of interests in different moments, as it were, of this time of a company's life, I think that's a good example. I'll give you one there.
I mean, I would repeat part of what I said before, is that the financial system is necessarily actually hierarchical, right? Sort of those with the biggest balance sheet will be able to bail out the rest, and if you don't find somebody who has a big balance sheet, then you will probably have to exit at some point with all the consequences. So, in general, it's always helpful to be very close to the guys who have the biggest balance sheets, and of course, in our world, these are the central banks. And I think given sort of the political backlash in the United States, it's probably nowadays safer to be close to the Bank of England, who will bail out the banks and then have the swap line with the Federal Reserve to get the dollars if they really need it. So if you need that kind of advice, that's what I would suggest one thinks about. I think sort of in terms of the regulatory framework, I don't think it really holds that much water, what we've done over the last couple of years in terms of really changing the regulatory system, and the private law system is still the same. So the whole machine has to be to create new types of jokers that are fitting into the scaffolding of the regulatory regime, so it's still enforceable in law, because we want to be able to enforce it, and then to be close enough to somebody who can bail you out if things go wrong, which probably will help. So trying to position oneself there would be that kind of cynical answer. Going back to the first question, casino capitalism and not casino capitalism. So Yes, we've seen periods that were more stable, and you could, I think, make an argument that banks, if they have to internalize the risk of what they're doing, they have to manage it a little bit better. But of course, banks are also inherently unstable. That's the whole idea of maturity transformation. So there, one can have a debate about whether you can control it better by having it inside the institutions or by having it, spread around the market with different intermediates and also assets interconnecting them. And probably we have reached a level of complexity that makes it very difficult, but I don't really see a fundamental line between what banks do and what the shadow banking system, there are no shadow banks, it's a shadow banking system, what it does, but it might have a level of complexity that we just cannot govern, and that might give us some pause. I'm not sure I've got the final question still, so I'll just pass it on if somebody else. No,
I don't think. Well, I mean, what regulation is going to do? I think it's a cat and mouse game. That will probably continue. I mean, we had this afternoon sessions on regulatory arbitrage and how lawyers construct instruments to get around certain regulatory requirements.
Who's the cat and who's the mouse?
Well,
that's a good question.
Good question.
Yes.
Okay, well, thank you very much to the speakers. Thank you all for coming here and also for your contributions. And as always, we're trying to sort of put on events that bridge over various disciplines, and I hope we have succeeded today in marrying law, economics, and perhaps even a little bit of sociology and politics. Thank you.
This is not mine.